because that's a financial principle that wealthy people live and breathe by. Just listen to Warren Buffett and his 2 rules of investing. He says rule number 1 is don't lose money. Rule number 2 is simply don't forget rule number 1. Participating mutually held life insurance companies have the best long-term track record of success when it comes to your money in the world. Companies come and go, some win, some fail, eventually most fail. That's why when you look at the S&P 500 today, the companies inside of the S&P 500 index look much differently than they did even 40 years ago. Hey, what's going on, cash flow hackers? It's Chris with Life 180, and today I'm going to be talking about my favorite topic, which is index universal life insurance versus whole life insurance, and which is better. Sound the bell, let's go. Here's the deal. I'm going to do a much deeper dive than I've ever done on this topic in one single video before. This is going to be the most comprehensive comparison of index universal life versus whole life insurance that you've probably ever seen. So first off, let's begin with the history of IULs. The first IUL, it's important to know, was created in 1997 by Transamerica as a response to the failings of the traditional universal life products that were created in the early 80s by E.F. Hutton. The growth of IUL sales was slow out of the gate. While several companies adopted IULs as a product, it wasn't really until 2009 when the popularity of index universal life took off. Let's face it, in a post-Great Recession world, the story that was sold then and quite frankly is still sold today of upside potential and downside protection gained massive popularity. Now, in more than a decade since the Great Recession, IULs have become the fastest growing segment of life insurance carrier sales in the country. In 2009, there were fewer than 15 companies manufacturing and selling IULs, but today there are nearly 50 companies that manufacture and sell them. Many would say that IULs are an amazing product due to the innovation and their ability to provide tax-free income at retirement, but the facts are, the jury is still out on what IULs will actually do long term. They're sold on big assumptions, a lot of trust in the insurance company, and with no real history to back it up. Later in this video, I'm going to share with you on why I don't feel IULs are necessarily a bad product, simply that they're the most missold and misrepresented products in the financial industry. However, before I do that, to keep with the same theme, here's a quick rundown of the history of whole life insurance. Mutually held whole life insurance companies were started all the way back in the 1840s. That's right. That's before the Civil War, before Abraham Lincoln was assassinated, before the institution of the Federal Reserve. We've gone through 3 different iterations of the dollar since whole life insurance was created. In fact, when people question why life insurance has all of the tax benefits that it has, I always point to the institution of the Federal Reserve. The banking cartel, as I affectionately call it, of JP Morgan and other elites in this country started pushing for a Federal Reserve after the Panic of 1907. This was nothing more, I should say, than a power play that changed the way money worked, not only in the United States, but soon enough the entire world. When the Federal Reserve Act was actually passed in 1913, where do you think most of the elite bankers, banks, corporations, and politicians actually held their own money? That's right, it was in whole life insurance. So while they changed the entire financial system systematically by instituting the Federal Reserve and with it, the fractional reserve banking system, which ultimately is designed to benefit more sophisticated and savvy investors and the government by creating inflation, which is effectively a hidden tax on the middle class, they kept the money that they had in their personal lives, in their businesses, in their banks. They kept that money largely held in whole life insurance. In fact, to this day, banks are the largest holders of whole life insurance in the entire world. They created laws and rules around whole life insurance that were designed to protect them, including massive tax benefits, protection from lawsuits, and much, much more. History tells the fact that whole life insurance companies are the best managers of risk on the face of the earth. There are no better financial institutions in the world at getting a good rate of return with the focus on preservation of capital. So why did life insurance companies focus on preservation of capital first? Because that's a financial principle that wealthy people live and breathe by. Just listen to Warren Buffett and his 2 rules of investing. He says rule number 1 is don't lose money. Rule number 2 is simply don't forget rule number 1. Participating mutually held life insurance companies have the best long-term track record of success when it comes to your money in the world. Companies come and go, some win, some fail, eventually most fail. That's why when you look at the S&P 500 today, the companies inside of the S&P 500 index look much differently than they did even 40 years ago. In 2009, 560 banks failed during the Great Recession. However, since the 1840s, the best participating mutually held life insurance companies have not only not failed, but they've successfully made money and paid a dividend to all of its policyholders every single year they've been in business. Now, that's anywhere from 120 to 170-ish years of consecutive success. Name me another bank or company that can say that. And I got news for you. This is why banks are the #1 holder of whole life insurance, keeping it on their books as a tier 1 foundational asset for the entire security of the bank. Now, as I look around, I like to try to make decisions logically and with common sense. Now, while there's no doubt that IULs will destroy whole life insurance in an illustration war, however, as I will show you, there's also no doubt that IULs will never perform as they're actually illustrated. Now, I know that's a bold statement. I know a lot of people are going to simply disagree with me and like to fight with me on it. But if you stick with me here and you use a little bit of common sense with me, I think it's going to make sense to you. So what I want to do now is I want to walk through a couple common sense points on why whole life insurance is actually going to be better than index universal life over the long term. First and foremost, common sense point #1, banks are the largest holders of life insurance, whole life insurance in the world. They use whole life insurance because of its guarantees, period. They don't want to lose money, preservation of capital, remember? They don't use IULs because bankers know that IULs have more risks than they're sold as having. Once again, not a bad product, just missold, right? If you think you are smarter than the largest banks in the country, you can go buy IUL, but you can also pay the price. Common sense point #2. Banks offer cash value lines of credit on whole life insurance. Here's how it works. You take your cash value in the whole life policy, whatever your net cash value is in the policy, and you can collateralize it using it to guarantee a line of credit, which is very similar, by the way, to a home equity line of credit, and you use your home to guarantee the line of credit there. Now, they will lend you anywhere from 95 to 100% of your cash value that you have available in your whole life policy. But what about IULs and banks offering lines of credit for them? You will be hard-pressed to find a bank that will offer a cash value line of credit for an IUL policy. And by the way, if you do, and there are a couple out there that do it, they only offer 70% of cash value for liquidity at most. Now, I know your agent is trying to sell you an IUL in the context of upside potential and downside protection, but if IULs were so safe, why wouldn't the bank be willing to offer you a line of credit against it? Just think about that. That's just common sense. And that leads me to common sense point #3, which is indexing is pitched as this magical discovery by agents all over the country. You know, indexing is pitched as this magical discovery by agents all over the country. The idea is to shave off some of the upside potential for protection and security of not being able to lose your money on the downside, right? That's simplistically how it's pitched. Now, that sounds pretty awesome. However, there are many problems with this that I will talk about shortly. In the meantime, this is my biggest challenge with indexing when you use common sense. If you illustrate IULs with most carriers, they show that you earn anywhere from 5.5% to 6.5% returns inside the policy after insurance charges. Now, you may not know this, but take this into consideration. Life insurance companies put policyholders' money into a general fund, right, into a general account, and then they manage that account. That account right now for virtually every insurance company as I'm filming this video is earning anywhere between 4 and 4.5% at the most. Think about that. If indexing was such a safe way to earn these great returns of 5.5% to 6.5% in that range, why wouldn't the insurance company be using the strategy with the entire general fund? The answer is because it isn't as good as your agent is telling you. If you could get 6% in your policy after charges, the insurance company should not have a problem turning a 7% return with no insurance charges, no admin charges, no management charges, no nothing, right? They should be able to do that, but they don't do it because it doesn't work that way. Now that I've gone over some of the common sense points, I want to cover some of the internal workings of IULs to show where their weak spots are and why I believe they are dangerous. I want to start by explaining in detail how life insurance companies allow their policyholders to participate in the indexes. So it's important to understand when a life insurance company allows its policyholder to participate in the index, you are not really ever invested in the index. Here's how it works. I'm going to go to my whiteboard here and I'm going to show you kind of how this works. So let's say you have $10,000 in cash value. Remember, I'm going to just say CV for cash value. Remember how I said you have 4%, well, let's just call it 4% return in the general fund, right? So what the insurance company says is they go, okay, we know on this $10,000, we have 4% return that we're going to earn on this $10,000 because, once again, life insurance companies manage their money better than any other companies on the face of the earth, right? So what do there? They go, we know that $10,000 is going to create $400 in profit for us. So what does that do? They then take this $400 and they buy options with it, right? So they buy options. And based on the cost of the options, and I'm going to get into this more later, this is how they are able to give upside potential and downside protection, hypothetically. Now, what happens is they go through here and they say, okay, if you buy a call option, I guess I should say call option. So if you buy a call option, and if the market does well, then you get the upside potential. You participate in the success of that option, and maybe you'll get up to 10%. If the market goes down and it goes zero or negative, then you lose this, and this $400 just goes away, and that's all you lose, right? And then you keep the 10%. Now that sounds really good on the outset, but the bottom line is, you're never really participating in the index. A lot of people have this misunderstanding that, you earn 0 to 10%, and they think that anything above 10% the life insurance company keeps, right? But the reality is they don't keep anything that is above 10%. They lose. In fact, no matter what, they're just building in a little spread. Their goal, the life insurance company's goal, is to just keep a little tiny spread. They make a very minuscule margin on your policies, and they have the admin charges, and they're taking this 4%. And if you lose it, the life insurance company doesn't win regardless. Whether you lose it and it goes negative, the life insurance company isn't taking on that risk. And if the market does 20% and you get paid 10%, the life insurance company is not keeping the extra 10% above that. That is all how options work. So it's important to understand that. So it's important to understand that cap rates are created by the spread there, right? Like, so based on what the 4% that they have to work with, or 4.5%, whatever the return in the general fund, that's what creates ultimately how they actually create the cap rate. Now, I'm going to get into that a little bit later because I want to explain a couple other things before I get there, because I think it'll make more sense once I do. There's one fundamental thing that you need to understand about IULs. The life insurance company has 100% ability to reduce your cap rates, reduce your participation rates, and or increase your internal costs at their will. In fact, I call it the ultimate trust me product in the financial space. Now, agents tout the financial security and the history of the companies that they're selling for, claiming that they would never put company over the policyholder. It's the ultimate trust me product in the entire financial space. Now, I know that agents are out there touting the financial security and the history of the companies that they're selling for, and they claim that they would never put their company over the policyholder. Well, a short jump back in history to the original Universal Life policies that were so similarly sold to how IULs are sold today wound up having massive issues in the 1990s. When life insurance companies were faced with the decision about paying policyholders or paying themselves and shareholders, who do you think they took care of? You got it, they took care of themselves and the shareholders. You see, most companies that sell IULs either still sell or sold participating whole life insurance at one point in time. A quick note, in a participating whole life insurance company, the whole life policyholder is essentially the equivalent of a shareholder in a publicly traded stock company. And now that you know that, this will make more sense. While a whole life policyholder participates in the success of the most successful financial institutions in the world, IUL policyholders are the most profitable products on the books for most insurance companies. In fact, Many companies shifted their marketing and sales tactics away from whole life insurance towards index universal life insurance so they could shift the risk away from the company and to the insured, the complete opposite of what people think they're actually getting. Many companies actually rely on the profitability of index universal life insurance sales to support the guarantees for their whole life policy holders. Think about that. I suppose this could have been common sense point number 4. So now let's talk about decreasing cap rates. The next point I want to spend time is I want to go back to what I was talking about before and talk a little bit more about decreasing cap rates. Now, first off, just to be clear, cap rates are the most that you can earn with your participation in the index in a given year. You take the cap rate and the participation rate, and that will determine the performance of the policy. So let me give you an example on this. If a policy has a 10% cap rate with a 125% participation rate in the S&P 500 index, and then let's say the S&P performs at 20%, you'll earn 12.5%, which is 125% of the value of the 10% cap, right? Now, if the market earned 5%, you would earn 6.25%, which is once again 125% of what the market performed at. Now, you have to look at both the numbers. You have to look at the cap rate and the participation rate. And you need to know that life insurance companies control the performance of your policy because they can control the cap rate, they can control the participation rate, they can do all that. And you need to look at what the minimum guarantee is that they can lower your cap rate or participation rate to in the illustration before you buy. Now, as a side note, even newer policies with no caps have levers in them that life insurance carriers can pull to reduce the performance. And I'm going to be talking about why that's the case later in this video in great detail, so make sure you keep watching. Now let's talk a little bit more about cap rate history just to prove this point. Since 2009, cap rates have dropped from over 16% to anywhere between 8.5% and 10.5% for most legitimate carriers. Now, why is that? Why would any insurance company reduce cap rates of these products during the greatest bull market that's ever been? And the answer to that is life insurance companies have created their own problem. Remember, over a decade ago, there were very few carriers, and today there are nearly 50 of them. If you go back and recall what I showed you about how insurance companies buy options to participate in the index, well, options have a cost to them. The more success companies had at selling index universal life policies, the more companies wanted to get in on the action and participate in that profitability. Here's the problem. That created massive competition in the options market, driving option prices up, which in turn reduces the performance of the index, right? I mean, not the indexes, but the cap rates, right? And the reality is it's been bad on both sides of the coin over the past decade for IUL companies. First, interest rates have gone down, which force the performance of general accounts down, right? When the interest rates stay low, it makes it hard for the life insurance company to get a better return. This in turn then reduces the budget for how much money they have to actually buy options, right? So they have less money to actually spend on options for their index universal life clients. Then secondly, the industry got flooded with competition and more companies competing to buy these options, and that drove the price of options up. So you had a lower budget and you had a higher cost, and so it's a double-edged sword, and hence cap rates simply needed to be reduced in the greatest bull run we've ever seen. Then to get creative, because cap rates were getting dropped so much, companies started creating their own proprietary indexes, partnering with other financial institutions. What they do is they cherry pick different funds and investments to allow themselves to be able to illustrate policies at higher amounts. But my advice to you is that you never trust a proprietary index ever. And I'm going to talk about that a little bit down the road here in this video. When it comes down to it, I suppose I could have thrown in another common sense bonus point here for bonus point number 5 or common sense point number 5. But the bottom line is it's just crazy. So this is a problem. This is a real problem that is this back and forth between insurance companies and regulators. And here's what I know, and just go look this up. Regulators keep changing illustration regulations because insurance companies keep creating policy features to get around regulations so they can sell more insurance. Once again, do not buy IUL based on the performance on the illustration. Case in point here, I'm going to give you a little history lesson and go back over, like, let's say about the last 12 years and give you the progression of how life insurance companies have created these illustrations and how regulators have changed regulations to counter everything. So not long after the Great Recession, AIG released an elite index IUL, which they allowed to illustrate at 10.25%. Think about that. That's crazy, assuming a 10.25% annualized return. This turned the market on its head and shifted the competitive landscape of the entire IUL industry to focus on illustrating IULs at the highest levels possible, effectively created an illustration war, right? Enter regulation AG 49, which was ultimately created in the spirit of controlling the unrealistic and irresponsible illustration war that was occurring. So what did insurance companies do after AG 49? Well, they simply went out and created charge-funded multipliers and buy-up caps to get around the system. Both of these concepts put a policyholder in a position where they're taking on more risk to get higher returns, which ultimately spits in the face of the marketed intent of the Index Universal Life product in the first place. Then, here's what happened. Regulators caught on to it, and they updated regulation AG 49 to become AG 49A, which clamped down on illustration benefits of multipliers and the buy-up caps. To react to this, carriers then shifted to what I was talking about before. They shifted their marketing efforts and they created proprietary indexes and no-cap products. They're creating indexes that they cherry pick to have great look-back performances so they can illustrate amazingly. Once again, they never perform as illustrated. All the while, you have agents who are unaware of the history of the industry and this product that we call Index Universal Life has evolved. They go around touting the greatness, most of the time with good intent because they just don't know what they don't know, but all the while, they put their clients in the crosshairs of having their retirement dreams just taken out by a sniper. In Bobby Samuelson's blog called Life Product Review, he mentions a new regulation, AG 49B, is likely forthcoming. The intent is to rein in the ridiculous and irresponsible illustration battles that continue today. At the end of the day, I believe common sense will prevail. The fact of the matter is that once you understand how IULs are built at an actuarial level, you know that long-term, an IUL will never outperform the performance of the life insurance company's general fund. If that's the case, why not just take the guarantees and go with the whole life product? That is the conclusion that I came to. Remember, when I first started my career, I was an IUL person. I shifted because of what I've learned, because I'm a nerd and I love history and I research this stuff, and when I learned what I learned, I couldn't go back to selling that garbage to people. If you have any questions or would like to discuss any of this, use the link in the description below to set up a free consultation call. Literally no pressure, no harm, no foul. But if you haven't already, make sure you subscribe to the channel, make sure you hit that bell, that way you get notified every single time I launch a new video, because we got a lot of great content on this stuff. Have a blessed, inspirational day, and I hope you found value in this, and we'll talk to you on the next video.